Okay, welcome to round number 4, results of your simulation. Okay, let's get into it. This year, you had another executive decision to deal with. So this one would have had some of you scratching your heads, and it was all around proactive operational risk. So you had the ability to go and look into one of three functional areas within your bank. There was no immediate concern, but you were going to be proactive and have a look at one of these areas, with the whole point being deepen your understanding of the organization and the processes, document the processes, find out if any risks exist, and understand if there's any controls in place and their effectiveness. So what we mean by controls is just basically saying we know that there's a risk and we've got something in place to help us manage that risk. So where would you actually focus your efforts this year? Would you have a look at the finance function and look at the 1,500 different scheme fees that are charged by Visa to your debit or credit card businesses and try to understand a little bit more about the drivers and the processes around those scheme fees? Would you have a look at the risk reporting team and see how asset information is mapped from finance systems to regulatory reporting systems, and is it being done correctly? Or maybe you'll have a look at the home loan process review and do a back end review of the process used to originate home loans. So those are your three options. And here is the way in which you actually chose. So we had one in every bucket here, one for the finance function, two for the risk reporting team, and the rest of you, four of you, going for the home loan process review. So this is an interesting one because this is actually based on things that major banks globally have actually done. And the way this is actually playing out is that if you did do the finance function, you would have actually found that there were 5 fees being incorrectly charged, and removing those actually gives you a cost saving of $25 million a year. So the reason why this is important is because this happens all the time in major organizations. So the complexity grows, you've got thousands of different fees being charged, thousands of transactions, and unless someone takes the time to actually understand a lot of those things, you can end up paying a lot more for things than really should be. In terms of risk reporting, this is something that banks have actually focused on a lot. So what you're doing is you're trying to correctly map information from your finance systems into your regulatory reporting systems. Why is this so important? Because if you don't map the information correctly, in terms of regulatory reporting, regulators such as APRA might actually provide you with a penalty or a penal overlay. So where that comes into place is, I'll give you an example here. Let's say you had a customer in your bank and you didn't have proper collateral data for them. When you think about the risk of that customer, you have the probability of default and the loss given default. Because you can't really determine that loss given default, the regulator would say, okay, well, you just go into the most conservative bucket. Let's assume that the loss is the highest. That then impacts your risk-weighted assets, and that means you hold more capital. So because capital is very important for banks, banks have really been focused on this. And what you're seeing in this example in the simulation is you end up reducing your business loan regulatory capital by $50 million permanently. And then the home loan process review. Now, this is something that a major bank within Australia has actually done. And it was a very long and intense process. It probably took them about 18 to 24 months. And they looked at all of the steps involved in originating a home loan. And there were thousands. And they streamlined that whole process down. By streamlining it, it actually meant that when customers do apply for a home loan, it's a much faster process. However, it also meant that there were less steps, there was less risk involved, so it provided for better risk outcomes too. And I know in chapter 7, in week number 1, you talked about the types of risks that financial institutions are exposed to. Remember operational risk. Remember, this is the loss resulting from inadequate or failed internal processes, people and systems, or from external events. And there's a big focus on operational risk because banks globally have been fined a lot for having poor operational risk practices. And all of these three options here were all around operational risk. It's all proactive stuff, it's getting on the front foot. And when banks do this right, it actually ends up obviously reducing the level of operational risk in the organization, but there's also strong business benefits as well. Okay, let's keep moving then. This year in your simulation, you would have found the market was starting to recover. You had home loans growing at 3%, business loans at 3.1%, deposits at 4%, credit cards were down again 6.5%. So this in your simulation has been a product in structural decline, and this is what's happening in the real world. A lot of younger people like yourselves might not really trust the credit card product. They don't really want to use the card product as much. You've also had a lot of buy now, pay later, new entrants coming in and taking a lot of market share from credit cards. And that's why it's been going down in your simulation. In terms of those losses, remember this is credit losses, 2 to 5 basis points for home loans, 5 to 150 for business loans, credit cards 2.5%. All right, let's take a look at margins. So this year there was no cash rate change, and if you look up the top here, you'll find that there was only a 2 basis point reduction in the headline price charged to all of your customers. And the cost of funds actually went down by 2. So when you put it together, you nearly had steady margins in this final year, but we saw the margins falling by 1 basis point. In terms of the individual banks, how they went. So well done to Levitate, Tells, and Unibank. You were the three that actually expanded your margins this year. But I think big round of applause here. UNPB, you had the highest absolute margins, followed by Group 7 at 282, and then NC Bank 23 at 262. So look, the reason why this is important, remember this is the fundamental act of a bank. So when you strip it all back, banks lend out money. So that's the black line at the top. They get that money from somewhere. So that's the red line down the bottom. And the difference between the rate that they pay for those funds and what they charge it out at is the margin. And this equates to roughly 70 to 80% of the overall income for banks globally. So it's really, really important. And remember also when we talked about rate sensitive assets, rate sensitive liabilities, I think you're talking about this probably in week number 2 when you're talking about interest rate risk. So there was that repricing type model where you had the difference between the rate sensitive assets and the rate sensitive liabilities. You needed to do a little bit of that here when you were thinking about what would happen if the cash rate changed, how would that impact my business? Do I need to make a change on that? Which is the way in which banks in the real world tend to look at these sorts of things as well at an overall level in terms of customer pricing. All right, credit risk. So this is your business lending losses, and what you're going to find is that those losses have all come right back down. So thankfully, they're not as bad as they were in round number 3. Now, some of you actually would have seen here that this picture here resembles a bit of an economic cycle. In a couple of years where it was flat and then it really spiked up and then it's come back down. And remember in week 5, you spoke a lot about credit risk. And remember there was 2 components here. There was individual loan risk and then there was that portfolio and concentration risk. And what you're looking at here is a bit more of that portfolio type level. So banks are very exposed to the economic environment. And just remember that, as the economic environment changes, banks' losses do tend to rise, which is where the banks are right now. They're very worried about losses, and there's been a lot of provisioning, forward provisioning for future losses. But it's not necessarily about minimizing losses altogether, because credit risk is a fundamental part of banking. There's always going to be customers who can't pay banks back. But banks try to think about pricing that risk, understanding the risk. And remember, there's all sorts of models that you can use. Things like, you can look at that RAROC type model, but you really want to understand what is the likely income that I'm earning on the capital that I have to hold on these customers. And I want to look at it over potentially a longer term period as well. So this is what you're having a look at with a chart like this. Some banks might be aware that they're going to experience high losses, but they would have charged for the risk and they would have made more than enough in the good times to compensate for some of those bad loans. All right, let's talk about your deal room. This year, Balmain Bank, I think, was up for grabs, and a number of duplicate back office functions were able to be eliminated, resulting in cost synergies. But there were some additional costs in relation to the integration of Balmain Bank. So synergies came out at 10%, which is the lower end of that 5 to 20% range. So we had 4 banks not bidding here. This time we had the PC Bank bidding. We had Group 7, $3.499 billion. That would have given you a 12.6% return. But you outbid Unibank, a big bid above you, $4.999 billion, 9.7% return. I think that might actually be shareholder value dilutive for you. But Tells beats them by $1 million here. Tells, you take home Balmain Bank. That's a pretty full bid. So I'm not too sure if that's actually really going to add that much shareholder value to you. And look, I think the point with these deal room bids is you may or may not ever get exposed to an acquisition, but generally it's been proven, there's been a lot of studies around this. Most acquisitions destroy value. And the reason they destroy value, there's a whole host of reasons, but some of the things are people get a bit of deal fever. They've been working on the deal for so long. They want to bid for it. They pay a really high price. Management teams get involved. There's a bit of empire building. There's ego. All of those things mean that the price paid is very, very high. People don't adequately consider the risks around these things, and often those things do eventuate quite quickly. So I'm not saying you shouldn't partake in opportunities, but I'm just saying that what you really need to think about is if you are going to take on an opportunity, make that decision with your eyes wide open. Think about the obvious positives. Also bring in some of the downsides. What could go wrong? What might derail this bid? If it did happen, what would that do to our returns? Are we comfortable with that? Sure, we want synergies to come in at 20%, but if they only come in at the very lower end, does it still actually make sense for us as an organization? All right, we're getting a bit of breaking news here. There's actually been a bit of a government investigation into banking practices and processes. Now, you were all given the ability to invest in different projects, and there were some pretty cool projects out there. Stuff like Project Digital, Project Big Data, Project Care Bear. There was a bit of a boring project. It was called Project Fix It, and that was all around proactive operational risk review. So, I mean, you spoke in week number 1 about the importance of operational risk for banks. It Having a look at those processes proactively might have meant that you found something, may have not actually found anything, but it looks like in this instance there has been a lot of things found. So there's been breaches of responsible lending practices, there's been insufficient key controls. Banks who weren't adequately invested in this would have received a $2 billion fine from the regulator, but we actually had 5 of you proactively investing in operational risk management. We had NC Bank, Goldman's, UNPB, Unibank, and Group Number 7. So all of you, you're going to still have a bit of a fine to deal with. You're going to have a $500 million penalty, but it's a lot less than what your other 2 competitors are dealing with. So well done to you 5. Some of you might be thinking $2 billion, that's a little bit over gamified. But if you have a look at this chart here, this shows you the big 4 banks remediation costs from 2017 onwards. I think you'll find $2 billion is light. This doesn't include the $1.3 billion AUSTRAC fine that Westpac had to pay. That was the largest fine in Australian corporate history. It doesn't include the $700 million AUSTRAC fine that CBA had to pay as well. So it can be very, very costly. It takes years to fix these things up. Additionally, you've got the regulator in Australia, APRA, making some of the major banks here holding additional operational risk capital. So at one stage, there was a $3 billion operational risk capital requirement across the board. But interestingly, last year, in September, the Commonwealth Bank of Australia had their operational risk capital overlay reduced altogether. Now, bear in mind that was 5 years after it was first put in. So that's 5 years of really long, hard work trying to prove to the regulator that they've uplifted their risk management practices. So this is a very effective way of doing it because that's shareholder money being tied up for something that it could ordinarily be used elsewhere. And you can imagine shareholders will be asking the management team, when are you going to get rid of that overlay? Why is it sitting there? What's going on? What are you doing to demonstrate to the regulator that you've resolved some of these issues? So a very, very effective way of doing these things. Okay, let's keep moving then. We've also got some more breaking news here. It's actually been found that the neobank has been found to have been facilitating financing of terrorism. So if you read the deal sheet that we were provided to you, you would have found that the neobank had a lot of great opportunities, but there was also some questions about their relaxed internal controls and lack of robust internal processes. So unfortunately, Unibank, the neobank that you picked up, was unknowingly allowing a terrorist organization to open accounts, send money overseas. So this is what we call KYC, or Know Your Customer. AUSTRAC has fined you $1 billion. But I think the bigger question is, what does this mean in terms of your reputational damage? Customers and shareholders are wondering what's going on. And I think the learning here is that, as I said to you before, in any acquisition, we want to make that decision with our eyes wide open. Unibank, there were some red herrings and there were some concerns about this deal. So you wanted to price that in and make sure that if you did get the deal, you were still comfortable with it, in spite of some of those things that might have been hanging over this. All right. In terms of bank bailouts, look, I think some of you have been struggling with this piece here. This really comes back to, remember, you were talking in weeks number 8 and 9 about liquidity and liability management. So you need to have enough funding. And remember, you can get funding from two sources. You've got depositors and you've also got wholesale funding. And those depositors aren't always guaranteed because they can lose confidence in banks, and that means that their money can leave. And remember, they can go elsewhere. They can go to a bank that's paying them more money. So it's very important to make sure we have adequate funding. And in the real world, there's requirements around this. There's that liquidity coverage ratio. And I'd mentioned to you that as a rule of thumb, you might want to hold about 10% of your deposits as cash, because that's roughly the level where banks globally are holding at the moment, or they were holding probably before COVID, actually. But what we've got here is we've got a few banks here. We've got TELS. You got a bit of a bailout here for 23 billion, not a large amount. UNPB 24, Goldman 39, and Levitate. I think you've had some issues around funding for a number of years now, but you've got an $89 billion wholesale funding requirement this year, an emergency loan. So when we look at the actual issues this year, you'll find that some of these banks have paid very, very high amounts. Unibank not needing any wholesale funding at all. So really, really good job there from Unibank. Just remember that this is it comes back to that liability management and liquidity management piece you were talking about. So holding a large amount of liquid assets keeps you safe, but remember there's a cost of holding liquid assets. And that liquidity coverage ratio, it makes sure that you hold cash and government securities, things that can be quickly converted to cash to give depositors their money back when they need it. But remember, those securities are low yielding, so you're earning very low amounts on that versus putting that funding into mortgages or business lending or credit cards would earn you a lot more. Okay, so there's a bit of a trade-off here between funding risk and the funding cost. Okay, so just bear that in mind. That's the real world implication here, and that's why it matters in the real world a lot. All right, let's talk a bit more about profitability and return on equity. So UNPB, you've built your profits back up to roughly where they were at the beginning of the game, $3.2 billion. Then we've got NC Bank in Group 7 at 2.4. Bit of a hit there from some of the fines and remediation. Unibank, Goldman's, TELS, and then Levitate. So bringing it all together, customer satisfaction was 40% of your overall score. Banks are obsessed with this in the real world because happy customers are less likely to leave. And you've done well here, Unibank. You've come out home in the final round here. You've moved into first place. Group 7 in second place. Levitate, you're always very strong on the customer side. But sadly, you've been pipped here at the post. But nice job. You all improved this. And like I said, the reason why banks want their customers to be long-term loyal customers is because it's cheaper for them to keep customers than to pick up new ones. And when you have a customer and they're long term, those balances they do compound over time. So it actually is a financial incentive to do this. And banks are really fighting for customer loyalty in the real world. Okay, every decision that you made in the simulation in some way, shape, or form would impact the shareholder returns. And in the real world, shareholder returns are very much a forward-looking view as well as a backward-looking view. So how much you generated off your investment and where you think your investment will be. It's the same concept here in our simulation. So at the end of round number 4, big round of applause, UNPB just pipping group number 7. And very nice work there, NC Bank. You're right up there as well. And then Goldman's and Unibank in, I think, 4th, 5th there. So putting it all together, where are we at the end of 4 weeks, 4 virtual years? Big round of applause. Do we have a new leader? We have a very close race. Group number 7. Fantastic work. UNPB just pipping, I think, NC Bank and Unibank. You're all fighting it out there for equal second. I think there's a whisker separating each of you, and then Goldman's. Look, the reason why they're doing this simulation is because, as I said to you right at the outset, one of the key things that the university really wants is to have workplace or workforce ready graduates. And this is really designed to help you bridge the gap between some of the theoretical pieces that you've understood in the course and also the real world applications. So we really wanted to help you increase your banking business acumen. You were forced to make a lot of decisions, and some of those decisions you're a little bit uncomfortable with, but we wanted you to see the rippling impact of those decisions. And in all honesty, a lot of people in very senior roles in banks don't quite appreciate those rippling impacts. So that's a really good trait for you to have and continue to expand and explore on that. You are forced to think long-term and holistically, something which is going to be very important in your careers. Because generally, when you're making decisions in these organizations, you're not just thinking about the immediate term impact, you're trying to invest for the long term. You are forced to work with people who you don't necessarily work with all the time. So hopefully you had some fun, you had a diverse perspective on some of these challenges. And lastly, we forced you to manage a lot of the banking trade-offs. Some of these trade-offs are black and white, and some of them are very, very tricky, and they're very hard to manage in the real world. So look, from all of us, we just really want to say a huge, huge thank you to all of you. We really do appreciate your time and your engagement in this simulation. If you do have any questions or comments, any feedback, please contact us at Accelerate Consulting. The email address is admin@accelerateconsulting.co. Please thank Lutfor if you did enjoy the simulation, because he's put a lot of effort into it, into designing it, so making sure it's aligned to some of the things that you're doing in the course. Do wish you all the best in your future studies and your work. And like I said, if you do want to have any questions or discussion, please reach out and make sure you contact us. But all the best, and thank you for your attention.